What's going on? Welcome to another brand new video. Today we have one of the most important topics when it comes down to investing in the stock market. A lot of people ask me, how do you get started picking stocks? I know this can seem very daunting as a beginner, but this is why I'm making this video to explain everything you need to know on how to pick stocks for beginners. Let's get started. Welcome to the Flaming Profits YouTube channel, where we teach you how to become a more profitable investor in the stock market. All of our videos are to help you and inspire you to win financially. Finances are one of the most important aspects that you need to pay attention to in order to live the good life. Sadly, this is not something that is taught by our educational system. So that is why I created this YouTube channel. Make sure you subscribe to the Flaming Profits YouTube channel. Also, make sure you like this video. Let's get this video to 50 likes. I really appreciate all of your support. And let me know what you thought of the video by a comment down below. Alright, let's get started. Alright, so the very first thing is you have to understand that you don't have to be right about every stock you invest in. And you won't be, to be honest. It is completely fine. It is okay. So, a lot of people, when they first begin to picking their own stocks, they might think that they have to be right about it, or they have to make a lot of money with the stock that they pick. But this is not the case. Even the best investors of our generation are not right about every stock they invest in. You're going to be wrong whether you like it or not, so you need to be prepared for that. So that takes a lot of pressure from picking stocks. The Lesson for Investors by Warren Buffett says, he makes an analogy to baseball. He says that you don't have to swing at every pitch. The trick in investing is just to sit there and watch pitch after pitch go by and wait for the right one in your sweet spot. And if people are yelling, swing you bum, ignore them. So he's basically saying that you don't have to go by what others are telling you to do or invest in. It is all up to your decision. And even though there's going to be a lot of opportunities in the stock market, it doesn't mean that you have to take part in it unless you fully decide that it is a good investment for your money. So you don't have to be right about every single stock you pick. For beginners, I always recommend to start with this example. So one of the easiest ways to pick your own stocks is analyze your life. What products or services do you use on a daily basis from publicly traded companies? Why do you use them? Do others use them that you know? Will you continue to use them? Then you should probably invest in the company. For example, let's say you're always wearing Nike shoes. You like the brand, you like the quality of the shoes, you like what the brand represents, and just you don't have any bad things to say about the company, and you're planning on continuing to buy Nike shoes or whatever Nike product it is. And your friends also like Nike products. So that probably means that they might be a good investment for you because you're willing to use their products, you use them every day, and you will continue to use them. So more than likely, there's a lot more people in your situation that will more than likely use Nike, and that company should appreciate in value, which will make the stock price go up on the long term. So you can pretty much come up with companies that you consume from on a daily basis and just decide to invest in them. And this is one of the easiest ways to start investing, by picking your own stocks, the easiest way. And you'll more than likely be very profitable once you start doing this. Once you have done that, you're going to want to invest into more stocks. So now let's get serious. Let's talk about the 4 different analysis that you can perform on stocks to pick the ones that will have the greatest return on investment on your money. Now, what are the 4 ways to analyze a stock? Number 1 is technical analysis. Technical analysis is a way to determine whether or not a stock is undervalued, overvalued, or at a fair price. Technical analysis is not really meant for long-term investments. It's more of a short-term trade that you're trying to do, or just an evaluation on the stock price of a stock based on this past performance. So I've used technical analysis a lot before, and it is one of the best ways that I use to analyze stocks to create a high return on investment, especially on the short term. Essentially, a technical indicator is a mathematical calculation that can be applied to a stock's past patterns like price, volume, or even to another technical indicator. Technical indicators do not analyze any part of the fundamental business, like earnings, revenue, and profit margins. All you're doing is basically looking at a chart and evaluating the stock based on its performance on the chart. And you can look at different graphs, such as the week chart, the month chart, the 3 month chart, the 1 year, the 5 year, and the max chart. And this is going to tell you where the price is at compared to its past. The way to make money using technical indicators is by basically buying a stock that is underperforming right now based on its past performance, and then seeing that it's potentially going to go up in value as it's done in the past. Let me show you an example with Facebook. I've made a lot of money with Facebook stock, and that's mainly because I've understood the technical analysis of the stock, and I'm going to show you what I saw and how you can apply this to any other stock. One of the easiest ways to make money with a stock is by making sure that the company you're investing in has a upward trending performance overall on the max chart. This means that over time, generally the stock goes up in value. Yes, it does go down in value periodically. It does have times when it goes down in value, like as you see here. But generally, as the stock progresses through time, it tends to make a higher high each time. So the lowest prices are in the beginning and the highest prices are now. And this continues to happen over time. These are the best companies to invest in because you know that no matter what, if you just continually invest in the company and hold it for the long term, you're generally going to make money. And this is what Facebook has done for a very long time. Yes, it does go down in value, and this is when you should buy heavy into the stocks. That way you can make a higher profit. And this is how I swing trade Facebook consistently. I just buy it when it drops in value because I see the value from its technical analysis, and it makes me feel very confident when investing into the stock. I even have $20,000 in the stock at one point. Alright, so here is an example of a bad stock based on its technical analysis. So here we don't see a clear distinction of where the chart is going over time. It's just kind of steady over time, and then it goes really high and then down. So it's very volatile, and it's kind of hard to basically analyze the stock based on technical analysis. You see Google here, how it's always making a higher high over time. This is a good stock, and you should buy it anytime it dips or goes down in value. Same thing with Amazon. What do all these amazing stocks have in common? They generally tend to go up over time. So make sure any investment you make sure it generally goes up over time. This will help you a lot to become profitable in investments that you choose. Generally, I like to draw a line of resistance, meaning that once it hits a certain price in the graph, it tends to go down in value, so that way you know that it's time to sell. I also like to draw a line of support. This is the line on the bottom that basically means once it hits that line, it's generally going to stay above that line. And you have to understand that technical analysis will not always be right. Fundamental analysis matters way more than technical indicators, but technical indicators generally depict what the stock has done in the past, and generally stocks do and perform as they've done in the past, but it doesn't mean it's always right. So this is just one way that you can analyze a stock. You can use multiple indicators in technical analysis, such as moving averages, charts, indicators, but there's also the second way to analyze a stock, which is generally a much easier way, which is called fundamental analysis. With fundamental analysis, you're generally analyzing the company, the industry that it's in, the future profit outlook, and basically how the business is doing and what it's expected to do in the future. This can get very complicated, but I'm going to make it very simple so that you know how to analyze a stock fundamentally as well. With fundamental analysis, you have to really know the company in depth. You have to know what the future profit outlook is for the company. You have to know what the economic conditions are. Is this stock generally going to do well in the current economic situation that we're in, or is it a bad time to buy the stock right now? This is what you'll understand with fundamental analysis. You're analyzing the fundamentals of the business. Let's take a look at this chart right here. that determines the differences. So with fundamental analysis, you're going to understand patterns in the company's financial performance. You try to predict the future performance using financial statements, and this is predominantly used for long-term investments. This depends a lot on financial statements, brokerage analysis, and news reports. The most common type of stock analysis is fundamental analysis, which is basically just when someone tells you, hey, I think this company will do well because this is what's going on in the economy, this is what the business is, this is a product and service, and this is why I believe that this product and service will grow in the future. So it's just analyzing the stock fundamentally. You have to question, is the company's growth strong? You have to analyze the liquidity of the company. Does the company have good capital allocation? You have to make sure you understand all of that. The next strategy is by using metrics, which generally is the same thing as fundamental analysis, but this is just additional things that you can look at. And this can be either a PE ratio, which stands for price to earnings ratio. It generally tells you whether the stock is overvalued or not at this current moment. So generally, the higher the price per earnings ratio, the worse it is of an investment. You generally want to buy stocks that have a low PE ratio. This means that you're getting a better value because the price that you're paying is generally lower than the earnings that it's expected to do. Usually high PE companies are like Amazon. This means that you're paying a lot for the stock compared to the earnings that it has. So if you generally find stocks that have a low PE and they will grow over time, then you're generally getting a very good value for the company once you buy the stock. EPS, earnings per share, tells you how much money they make per every share that you own. You generally want to have a high EPS because this means that the company is more profitable. So you're going to look for a low PE ratio of a company and you're going to want the highest EPS you can. Number 4, we already talked about that, the fundamental analysis. The one we left out is financials. So financials is one of the most important aspects that you need to analyze a stock by. And this is generally just looking at the balance sheet of a company. The balance sheet will tell you how many assets the company has, how much debt they have, how much income they're having every quarter. The financials are basically the bloodline of a business. Without good financials, there is no company. So to keep it very simple, I just look at the total assets. This just means that how much assets a company has. Generally, the more assets, the better. And as you can see here, Tesla, from 2017 to 2018 to 2019 to 2020, they've been continually improving their total assets, which is a good sign that the company is doing better than before. Next, we also have the working capital. Generally, the more working capital it has, the better. Now, if you look at the income statement, we see that the total revenue, it keeps on generally increasing every year. So this is a good sign. The operating income, you generally want to have a lot of operating income. The total debt, you generally want to see less debt than total assets. So the lower debt it has, the better. So as you see here, we started at 12, then 13, then 14, then 13. So it's been pretty flat, and I liked it a lot because this means that their total assets keeps on growing, but the total debt is not really increasing by that much. So that's a good sign. Generally, you want to buy stocks and companies that have a lot of assets and they continue to increase that. Their total revenue keeps on increasing every single year. Their debt is very low. A company having good financials will make you resistant to market fluctuations and economic conditions. Let's say a pandemic happens again. More than likely, the companies that have the most cash and the more assets and the less debt will generally perform way better than the rest. So those are the 4 ways to analyze a stock. We have technical analysis, we have financials, we have the metrics such as the price to earnings ratio and the earnings per share metric. There's also so many more, but those are 2 of the most basic that you need to understand. And number 4, fundamental analysis. So yeah, those are the 4 ways that you can identify stocks that potentially have a great ROI. This is what you can do to start investing into stocks. You see, it is not really that complicated and anyone can start doing it. It might just take practice, but start implementing and always remember that you don't have to be right about every single one. Alright, so here we go. Thank you all so much for joining me in today's video. If you want to get 3 free stocks, make sure you hit the links in the description down below. Also, M1 Finance will give you $10 for you to get started investing with them. It is a very easy platform. And then the Discover Secure credit card is going to give you a $50 sign-up bonus. All these links help out the channel, so I really appreciate your support. Make sure you like this video, subscribe to the Flaming Profits YouTube channel, and leave me a comment down below. If you're interested in a $15 cell phone plan that I use, I'll have the link down below. Unlimited texting and data nationwide. Alright, so I do have a question for you. What are some strategies that you use to pick good stocks? Is there anything that you recommend for us to follow? Make sure you leave a comment down below. Alright, I'll see all of you in the next one. Peace.